Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 41 on December 22nd, 2018. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Pandora Media, Macy's, and Morgan Stanley, and then we'll look at three new trades for this week on JD.com, Micron Technology, and British Petroleum. Now, it's always great to hear from listeners, so if you have any questions about the trades presented here or about, your own positions, feel free to email me. You can reach me at Eric, E-R-I-C, at theweeklyoption.com. And I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab, or you can find us on YouTube, the YouTube channel for the Weekly Option. Now, I think the biggest news, there's quite a bit of news actually this week, but from an economic standpoint, on Wednesday we had a announcement from the FOMC, the Federal Open Market Committee of the Federal Reserve Bank, and they decided to raise the interest rate, or the Fed funds rate, once again by 25 basis points to a range of 2.25% to 2.5%. That wasn't the biggest part of that. What was more important, I think, was what they said after that. And they said due to weaker economic data here in the U.S., we'll likely only have two more increases in 2019. So that's a clear sign that not only is our stock market lowering, but our economy is slowing according to what they're looking at. And part of that, of course, is the stock market. But another thing that's happening is we have a strong dollar right now, and that's affecting our exports abroad. So that being said, this was actually the worst week. I'm sure you guys have already seen the headlines, but it's the worst week we've seen in the markets, in the equity markets, in a decade. Equity markets finished roughly 7% lower this week. So the Dow Jones Industrial Average fell 1,655 points week on week, finishing on Friday at 22,445 points. And the S&P 500 index fell 183 points, finishing up at 2,416 points. So that's quite a significant move week over week. Now, there are only 8 companies announcing this upcoming week. I'm surprised there's that many. And I'm really not following any of the 8. On Tuesday, we obviously will be celebrating Christmas around the world, but definitely the U.S. stock market, the equity markets, and the commodities markets, for that matter, will be closed on Tuesday. So this upcoming week will be a four-day work week. Now, as far as topics of the week, a good friend of mine asked me a question, and I figured I would make that the topic of the week this week, and it had to do with interest rates, right? So what happens when interest rates increase to options? So, what should you expect from your options when you have this? And realize before I begin this, interest rates are only one part of the factor with options. You still have the actual movement and the underlying. You have the volatility and how that can change. There are all sorts of things that can affect the options price, but interest rates are one of them, and can be a significant one as well, but oftentimes not. But it's important to just understand how all of these different levers, if you will change the expectation for your options. So the reason interest rates matter is because this is all finance, time value of money. So I was explaining to a friend that if I borrowed $100 at 10%, that means that the expectation, the full value of that loan next year is $110. If we raise interest rates, the full value of that loan package will increase. So let's say we raise interest rates by 1%. Well, now that loan that I took out today for $100 has an expected value in the future of $111. So when you increase interest rates, you can see that the end value, the expected value of the asset, the loan, actually increases. And with options, what we actually are doing is we are pricing and trading off of the expected future value of an asset, of this option, based on where stock prices end. So much like that loan, if interest rates increase, we expect the overall package to increase, the end result. So let's say that we own calls. Well, if we have call options, if we own call options, at the end of the day, when the expected value at the end increases, that means the value of that call option went higher, or the value of the end result went higher, and so that call option actually increases in value. And on the opposite, because we know that puts increase in value when the stock price goes down, or when the future expected value of that stock goes down. If we raise interest rates and we own put options, then the increase in interest rates will actually make the put option worth less. They lower in value. And it's the same for call spreads and put spreads, right? So raising interest rates, if you own call spreads, will actually increase the end value of that, and likewise decrease the put spread value overall. Now, there are some caveats to that too. I mean, with a put spread, or with a spread in general, we know that from the start, our spread has a maximum value of, say, $5. If the difference between the strikes is $5, so that's not going to change. So spreads are a little different, but that's it. If you're ever listening to some of the economic news, it's always important to understand how that news can affect your option position. And it's the same for all sorts of things. If you're trading a company that has a dividend, what happens to your options. So we might cover that in a future one too. And definitely, if there's a topic that you guys have been wondering about, email me, and maybe I'll cover it. Definitely, if I think it's one that affects a lot of people and that others might have a question about, we'll cover it right here on the broadcast for that next week. So that's it. Hopefully, you understand that whole interest rate and time value of money package. But at the end of the day, if you think about it like a loan, and that how raising the interest rate will make the end value of that loan more expensive, then hopefully that'll help you understand what's going to happen to your options. So that's it for that. Let's look at the trade results from last week. And once again, we will see 2 out of our 3 trades mentioned be profitable. The way to make money when the sky is falling, and the sky has definitely been falling, is to sell call spreads and buy put spreads. And so that's been the trade for the last 7 weeks. And we've consistently struggled to make profit on the covered call, and that's going to be the same this week, obviously, with that drop in the market. But for 6 of the last 7 weeks, we've sold call spreads, and for the last 7 weeks, we've been buying in the money put spreads, and so it's going to be similar this week. And then, of course, yesterday, Friday, December 21st, is expiration for December option positions. So at this point, any of your positions, all of your positions are valued at intrinsic value. So if they're in the money, they are valued at their stock equivalent level. And if they are out of the money, they are officially worth 0. So those call spreads we have been selling have no value, and the money you collected when you sold the spread on those December options will remain happily in your account. So give yourself a high five and a pat on the back for that. Now, last week we looked at a covered call on Pandora Media, symbol P as in Paul. The stock at the time was trading for $8.65. And we looked at selling the January 9 call at 18 cents. And it was going to yield about a 6% return in 5 weeks. Well, Pandora stock fell 94%. I'm sorry, not 94%. Pandora stock fell 94 cents this past week, closing at $7.71 on Friday. So that creates a loss for the position. As we know, the biggest risk in these trades in the covered call is the stock that you own, not the actual option. Now, the January 9 call, which we sold for 18 cents, can now be repurchased for 8 cents. So you can lock in a profit of 10 cents. That will lower your overall loss on the position to 84 cents. And I would look at then selling the January 8 call for 20 cents. Now, given where stock is right now, if the stock rises in January to $8 per share, you will lock in 30 cents of profit in these options and 29 cents in the stock overall for a total of 59 cents. That would still leave you with a net loss of 35 cents, but that's better than a net loss of 84 cents, which is where it is right now. So, again, I've mentioned on previous shows, I'm not a fan of covered calls, but it's important to cover them here on the show, mostly from the standpoint, let me rephrase that. I like covered calls if you already own the position and you intend to keep it. So let's say that you used to work for a company, or maybe you still work for a company, and you like the overall prospect of that company. You want it to be in your portfolio, long into the future. Maybe it's even a stock that you hope to provide. You hope to be part of your legacy, part of your financial legacy, at least for your posterity. What ends up happening is you can still sell calls. I would not advise selling at the money calls like we do on this show. I would look at selling further out of the money calls, and then just make sure, like if it's a stock that you really want to keep, just make sure you watch it so that ideally you're collecting additional return for being long that stock, month over month. But at the same time, if the stock moves and you don't want to have that call option end up in the money, because then you'd have to give away your stock. You just have to adjust your position accordingly, either buying back that call which you sold, or buy more shares to deliver against that option. So lots of things to consider. But as far as entering, the way we discuss it on the show, as far as going out and saying, hey, on Monday I'm going to buy this stock and I'm going to sell calls against it. Right now, with the market falling so much, it's not really the time for this strategy. It's a great time to sell call options. It's a bad time to be buying stocks. So just keep that in mind as we do this every week. And I like to remind people of that every week, or every now and then, just so you know, my favorite trades, and they don't always work. But my favorite trades are the spreads that we discuss afterwards. So let's get into that. The credit spread that we talked about last week was on Macy's, symbol M as in Mary. Stock was trading for $30.61 at the time. We looked at selling the January 31-32 call spread and collecting 38 cents. And that would create a maximum loss of 62 cents per spread. So Macy's stock fell $2.41 this week, finishing the week at $28.20 per share. So the out of the money call spread, which we sold, is even further out of the money at this point, which is great. Now there's still quite a bit of time. There's 4 weeks left in this position, but you could close the trade today and lock in 7 cents of profit. Of course, I'm going to wait because locking in 7 cents means that you're walking away from 31 cents of possible profit. So as long as prices stay, almost 10% out of the money, possibly headed lower, I'm looking at holding onto this position. Now, like I said, there's 4 weeks until January expiration. So, let's ride this one a bit longer, but definitely keep an eye on it. I don't like you never let winners turn into losers. I've had times where winners will turn into scratch, but you don't want to give up everything on this trade. So keep an eye on it. And same is true for this debit spread on Morgan Stanley. Morgan Stanley last week was trading for $39.64. We looked at buying the January 41.40 put spread for 61 cents. And that creates a maximum gain of 39 cents, or nearly 64% return, in 4 weeks. 5 weeks last week. So Morgan Stanley stock actually fell nearly $2 this week, ending the week at $37.68 per share. The in-the-money put spread that we bought is even more in the money now, so that's fantastic. Given the closing price on Friday for the options, you would actually lose a nickel if you tried to cross the bid-ask spread to exit this trade right now. But again, what's the hurry? The trade is working, and we have some cushion in the price in order to keep this trade profitable. So remember, we make the most money in this trade when stock finishes below $40 per share. And right now we are $2.32 lower than that. So I will ride this one a few more weeks and see how it ends. And if I'm at some point able to lock in a significant portion of my profit, my maximum profit on this trade, then I might close the trade early. But for now, I'm definitely happy with the direction that things are going, and I'm gonna wait it out. So I don't know if you guys feel the way I do. I mean, by selling calls and buying puts, we have been profiting as the market goes lower, and that is the ultimate goal. Especially if you guys are long stock in your 401k, you have to have understand options well enough to have a offset to that when the market is moving against you. The downside, of course, to trading is that sometimes we end up high-fiving or celebrating when everyone else is crying. And at this point, this year is definitely ending on a very negative note. So in the equity market, at least. So, but we are positive and making money. So it's great, but it always feels weird to be celebrating. I guess ultimately cheering as people are losing money. But it's the nature of the beast. We'll trust me, when markets start moving back higher, we'll be making money then too, because we'll probably be selling put spreads and buying call spreads in the money again. So it's just that this trend has been strong and the momentum has been so strong. I even, for this upcoming week for the trades, I even looked at possibly, switching it up a little bit, maybe selling a put spread, maybe looking at buying it in the money call spread. And then I thought to myself, like, why? Because my goal is never to catch a falling knife. If the market is going down, don't fight it. Just wait it out. And if, keep an eye on it. And if it changes and you're watching it, you adjust your trades then. But I don't buck the trend. I try to make trades that benefit from the trend. And I also am never trying to, I don't want to predict where the stock is going. My hope is to just follow the trend on where it's going. And I'll tell you just a side note, or actually we haven't covered the trade I was about to mention, but getting ahead of myself. So now, this week's trades are largely educational, and that's because Friday, with Friday having been expiration, there are several new strikes. The half strikes will be listed on Monday, and those are not priced yet. So there may be some better opportunities in the market on Monday morning. And you guys have heard me say this the day after expiration multiple times. Just follow along and definitely take a look on Monday morning and see if there's something that better fits. That's what I'm going to be doing. So this first trade is an interesting one. I'm looking at the covered call on JD.com, symbol JD, Jason David. Stock finished the week at $21.08. And I'm looking at selling the January 22 call against it at 94 cents. Now that would yield an 8.82% return in 4 weeks, and you would enter this trade by buying shares of JD stock for $21.08 and then selling that January 22 call at 94 cents. Now, the only reason this trade even popped up on my radar is because of the headline, the news. JD.com is an online, like an e-commerce supplier based in China. And if you guys have noticed, they had an executive that was arrested for some pretty serious charges in Minnesota a couple of weeks ago. He was released because they don't have enough evidence to go ahead and prosecute him. And so that actually is a strong sort of a news headline for this stock. The stock has been trending lower for quite a while too, so I'm not certain that I would want to fully own this stock, but because that call option is so juicy, it makes me want to go ahead and sell that call and have the stock as a hedge. I think that stock is going to get some good movement over the next week, mostly because of the headline, the news event. Having your executives arrested abroad is never good for a stock. But now that he's going to be heading back home, I think this will be good for the stock. And we'll just see how it goes on the next week. But, again, is this one that I would actually execute for myself? Probably not. Now, the next two, I would, and we'll be watching. So The credit spread that we're looking at this week is on Micron Technology, symbol MU, Mary Uncle. Stock finished the week at $30.32, and I'm looking at selling the January 31-32 call spread and collecting 38 cents. Now, because it's a $1 wide spread, that creates a maximum loss of 62 cents in 4 weeks. Now, you enter this trade by selling the January 31 call at $1.65 and then buying the January 32 call for $1.27. This is a credit spread because we're selling the spread, and this trade makes the most money if stock prices stay below $31 per share. So, I mean, you throw a arrow or throw a dart at the stock price listings, and you'll find all these stocks that are clearly trending lower. And so this just happens to be one of them that I liked, and I liked the premium, the amount of premium that I could collect. That 38 cents on a $1 spread is pretty rich, it's pretty high. We did the same thing last week. And so that's why I chose Micron Technology. But there's a lot of opportunity out there this week. Sometimes you have to, when a call spread is juiced up, you kind of have to ask yourself, okay, why is this juiced up? So the first thing I look for is news, individual news on that stock. And then the next thing I look for is, earnings. Are there any earnings or some other news event, FDA announcements or anything coming up? So just keep an eye on that as you're looking at selling spreads and also buying spreads, because you still can lose money. The good thing about the spread, of course, and we talk about this every week, is that like if you sell the spread, these credit spreads, your maximum gain is reached on day one. So I received that 38 cents. And now it's really just a matter of making sure that I don't lose that other, the maximum loss, which is 62 cents. On the debit spread, which we'll cover in a minute, your maximum loss is what you pay for the spread from day one. So you're getting your maximum loss at day one, and then your return is significantly higher on a percentage basis, but it's just the same. So our debit spread this week is on the company formerly known as British Petroleum. I think they rebranded years ago simply as BP, Brian Paul. The stock finished the week at $37.67. And of course, this is one of the largest oil producers in the world. And given that oil is below $50 a barrel, and has been pretty weak right along with our economy, as well, Brent has been Brent crude, which is what's traded by the rest of the world, has been significantly lower as well. So it's no surprise that this stock is much lower right now. Looking at buying the January 39-38 put spread, so it's an in-the-money put spread, we will pay 62 cents for the spread, looking at a maximum gain of 38 cents, because this is a $1 wide spread, so maximum gain of 38 cents, which is a 61% return in 4 weeks. Now you enter this trade by buying the January 39 put for $2 and selling the January 38 put for $1.38. This is a debit spread because we are buying the spread, and this trade makes the maximum amount of money if stock price stays below $38 per share. So that is it for the week. Hopefully these trades and this market scenario make sense to you. Hopefully you've been making some money along the way, and yes, the sky is falling, but it won't fall forever. I'm looking at I'm expecting these next couple weeks to be volatile. When you have a market that's so much lower, and we've got 1 week left in the year as far as the markets are concerned, just keep an eye out. There are a lot of guys that are incentivized, a lot of professionals, money managers, pension fund managers, mutual fund managers, that are incentivized based on how they perform relative to the market. And with the market being lower, you could end up seeing a situation where we just have an amazing bull rally over the next week. Now, I doubt it, given how far we are away from getting back to even. But the market moved 7% this past week. That's unreal. Could it be up 7% this next week? It absolutely could. So keep an eye on it. Watch your positions. Finish out this year strong. The good thing is that we are fully trading January options. So even if they move against you, you'll have 3 weeks, based on next week's show, to make some adjustments and decide what trade fits best for your portfolio. So have fun. Hey, have a Merry Christmas on December 25th as well. Hope you're enjoying this time with your friends and family. Even if you aren't celebrating Christmas, I hope you're getting a moment to just take a look and step back and breathe a little bit and prepare for 2019. I will be mentioning the optionstudio.com again next week. Probably will be having a webinar here soon to discuss the trade types that I'm looking at entering for this next year, for 2019. So I'm an optimist. I always expect it to be a great year. And this is the time to prepare for it, right? You don't get ready for the big game when the game's going. You get ready ahead of time. And so, this is off season. If you've made money on the year, it's not a bad thing to kind of take a step back and just enjoy a few days and then come back strong in a week for the new year. So that is it. Happy trading if you decide to be active this week. And if you have any questions or concerns, topics, comments, whatever, I'd love to hear from you either way. Reach me at Eric, ERIC, at theweeklyoption.com. Have a great week. Happy holidays. Take care. Bye-bye. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.